The following is paid programming.
You're listening to Something More with Chris Boyd.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.
Something More with Chris Boyd, certified financial planner professional. Now, your fulfillment facilitator.
Help me. Help you. Help me. Help you. Help me. Help you.
Your partner in prosperity.
Show me the money! Derek, you better yell! Show me the money!
Advising clients across the country. Here he is, your host, J. Christopher Boyd.
Good afternoon, and welcome to another edition of Something More with Chris Boyd. My name is Jeff Perry. I have the pleasure of sitting in for Chris this week as he is away at a conference in Chicago, I believe. I hope he's having some fun while he's doing all that work. I don't know about how much work you actually get done at a conference, but we hope he's having fun and getting a lot done. And I really enjoy sitting in for Chris. In this first couple of segments, we're going to have Mike Perna, who's a certified financial planner with Asset Management Resources. He's going to continue a conversation he had last week about the 10 most important things he's learned in his over 40 years of financial planning. In segment 3, right before the news, we're going to bring in our Chief Investment Officer, Brian Regan, and we're going to talk about the term, perhaps what's going on. We'll hear what Brian has to say about bear markets. In the second hour, we're going to bring in another certified financial planner, Jeff Tomaning, and he's going to talk about how to live in this new world of higher inflation, whether it's you're in retirement, approaching retirement, things that affect your everyday spending, and maybe some suggestions on how to reduce your spending in these times of inflation. And in the last segment, we're going to bring in our marketing director, Kathy Ingersoll, and we're going to talk about what's coming up at Asset Management Resources. We have a webinar coming up. We're going to talk about a new program, Something More Mentoring, that I'm leading, and Kathy's certainly helped me get it going, so that's exciting. Stay tuned for details about that. But before we get into any of these financial topics, and before I get Mike on the air here, I want to remind everybody that today is Armed Forces Day in the United States. Armed Forces Day is the third Saturday in May, and that's where we are today. And it's not Veterans Day, it's not Memorial Day, it's Armed Forces Day. And the difference between those three holidays, if you will, is we know Veterans Day is the day in November 11th, designed to honor and pay respect and remember all of those who have served us in the past. So someone's a veteran, they served honorably in the military, and we celebrate that with parades and events, and it's a wonderful opportunity. It started at the end of World War I. They called it Armistice Day. And we all know at the end of the month here, Memorial Day, that's the day when we honor our war dead, those men and women who paid the ultimate sacrifice in service to our nation. And so what's Armed Forces Day? Well, Armed Forces Day is to stop, remember, honor those who are currently serving. It was created in 1949 and signed into law by Harry S. Truman. And as I said, it's the third Saturday of May, and that's today. So let's be thankful for all the men and women who are across the globe, away from their families, ready to answer the call to defend our freedoms. And if you know a member who is serving now, send them a text, send them an email, call them, and say thank you. We can't say thank you enough to our service members who are serving today, our veterans who have served before, and those who have paid the ultimate sacrifice. So Armed Services Day, Armed Forces Day, that includes the Army, Air Force, Navy, Marines, Coast Guard, all the branches of our armed service. We thank you for your service, and God bless you all. So, Mike Perna. Mike Perna was on the show. Well, he's on the show a lot, but he was on the show last week talking about the 10 most important things that he's learned in over 40 years of financial planning. Mike, are you with us?
I'm with you all the way.
All right.
When I hear that 40 years, I cringe.
Well, I'm sure it's gone by really fast, and I'm sure you have forgotten more that you have learned than most of us have learned in the business, and you've had endless experience with a variety of type of clients. And you were on the show last week, and you started to talk with Chris Boyd and I about the 10 most important things that you've learned. And this list comes from a paper that you put together. I think it's going to turn into an article for one of the financial magazines. I hope it does. And we spent a segment or two last week on it, and we just didn't get through the list, but the conversation was so important and so productive that I wanted to have you on this week for a couple of segments. So I hope we can finish the list. Last week, we kind of went through the first three. For those who weren't listening, or just as a reminder, you talked about to invest in yourself first. You went on into great detail about that. You talked about spending time with your family. You'll never regret it, is your opening line there. That's so true. Number 3 was know where your money's going, and that was a focus in budgeting. So I'd like to pick up, Mike, if we can, at number 4 on your 10 most important things that you've learned in 40 years of financial planning, and that's time is your friend, don't make it your enemy. What do you mean by that?
Well, when we start out in life, usually after high school or college, we get our first job, and we're asked if we want to contribute to the company retirement plan.
Right.
And when you're young, there's less incentive to do so, simply because you think, time is in the future and you'll be able to start, when you're maybe 30 or 35.
Right.
It's a big mistake. Start as soon as you can, okay? The reason being that the longer you hold money in an investment, okay, the greater the return will be over your lifetime. So you want to start, okay, as soon as you can. Not only, will that help you to accumulate more money, it will also set your mind in a way that you can live without the money. You can adjust the way you live. When I was younger and when I got married, money was always tight. But once I started contributing to a retirement plan, I found 2 things that were very important. Number 1, if I was contributing, let's say $100, it didn't reduce, okay, my input, my take-home pay by $100, only by $70, and that's because it was before tax. Okay, and since it was before tax, I didn't pay any tax on the money. So as a consequence, okay, my take-home pay didn't go down by $100. It went down by about $70.
And my guess, Mike, is that if you do it from the beginning or near the beginning of your career, you don't really miss that money. You find a way to pay your bills and do the things that you want to do, take care of your family, if you put yourself on automatic pilot and kind of put it out of your mind. Is that your suggestion?
Yeah, I think, that's the most important thing that I've learned about savings. Don't put the money in your hand.
Right.
Okay? You'll never make it if you do. You can't see the money.
That's right.
The money has to go directly from your paycheck into the retirement plan or the savings program that's being offered. If you take the money home, well, the chances of it winding up in a retirement plan or a savings plan are close to 0.
It is. And you lose that pre-tax benefit more than likely that you were talking about. Mike, you also talked about number 5 here. Don't be too conservative. what are you trying to say there?
Well, oftentimes, people talk about not wanting to lose any money. Okay. And I have to question what they mean by not losing any money. I mean, they could put money in a savings account or a money market fund, and they'll turn around and say, I didn't lose any money. Okay, the stock market's down this year nearly 20%. But people who have money in savings accounts, okay, haven't seen their balance dip. Well, let's take a closer look at that, okay? First of all, the incidence of the stock market being down, okay, is only for a very short period of time. History shows that over time, the stock market goes up. And the returns of the stock market versus the bond market or cash, money market funds, is usually 4 to 5 times greater. So if you want to increase your savings, you do have to take a risk. But what is a risk? A risk, okay, is the chance that you might lose some money. But if you keep money in your investments and don't sell them, okay, there's virtually no chance that you're going to lose money because the stock market has always come back from what it has given up. So
Right. For
this
those
is something
investors,
that works in your favor.
Mike, and you're talking about long-term investing, right? So you're talking about over periods, from 10 years or so, that the likelihood, and history tells us that the likelihood of a negative return in any 10-year period is virtually non-existent.
Yeah, that's right, Jeff. I mean, certainly there have been times when, in 10-year periods, when you put money in the market and it has gone down, and you're actually lower at the end of the 10-year period than you were before. For example, in the first decade of this millennium, okay, from 2000 to 2010, had you put in $1,000 in the stock market on January 1, 2000, well, 10 years later, you would have had less than $900. And that's because the first 3 years of the decade, we were down 44%. And then in 2008, we were down 37%. So that was a negative decade. But, okay, that's unusual, very unusual. So what we're trying to say to you is keep an eye to the long term. And if you keep your money in, you will not lose. You will make money. It's only when you sell that the possibility of losing, okay, becomes something that it could become a reality. So
thank you for that, Mike.
And keep it invested.
Keep invested. There's an old maxim that says it's not the timing of the market, meaning buying and selling, it's time in the market. And I think that's what you're saying. Make consistent investments, use the concept of dollar cost averaging, which means, to simplify, is to putting regular amounts in the market on a regular basis. Therefore, when the market's down, you're getting stocks, if you will, at a better price. And when the market's up, you're buying less shares. And all these strategies that we talk about on this show and with our clients is to stay invested for the long term. Certainly think about your risk tolerance. That's an individual thing. How much risk can you tolerate, where you belong, how close you are to retirement. All those things are individual conversations we have with our clients. But you're right. If you can't be too conservative because, especially in these times of inflation, if you're just parking money in cash and inflation is running at, 5, 6, 7%, you're actually having a net loss with your spending power. So that's good advice. And I think that's a hard one, Mike, not be too conservative for some people. But if they really look at history and they look at the history of returns on the stock markets long term, they'll see that it is the place to be. And I read a lot of books, as I'm sure you do. And there's a book, The Millionaires Next Door. And it studies and talks about how the average person became a millionaire in their life. And the number one way, without even a close second, of how someone becomes a millionaire is through regular savings in their retirement account, whether that be their 401k or an IRA, and sticking with it over long term. That's how most of the millionaires, we're not talking about the family money or inheritances, we're talking about the average person who can become a millionaire in this country, and they can do it by consistently investing in the stock market over long periods of time. So you're right on target with there, Mike. We're about to take our commercial break, but I want to tease the next subject. Mike, when we come back from the break, you're going to talk about number 6. There's good debt, bad debt, and you need to know the difference. We'll be right back with Mike Perna on his top 10 most important things he's learned in 40 years of financial planning right after this brief commercial break.
Springtime. It's that time when all around are the signs of new life. It's invigorating to see flowers blossom, trees turn green, grass come to life, and enjoy some warmth and fresh air. Hi, Chris Boyd here with something more for your financial well-being. Just as this is the time of year when we celebrate renewed life in the season, it's also an opportunity to take a fresh look at your portfolio. What may have seemed to be dying a slow death in the winter may have an opportunity for renewal. Meet with me for a comprehensive portfolio review. We can see what's working and what might be better to change. With a little pruning, perhaps your portfolio can bear new fruit once again. If you need help in your financial or portfolio planning, reach out to us through our website, amrfinancial.com. That's amrfinancial.com. Asset Management Resources, for those intent on a secure retirement.
Hi, I'm Keats Boyd from Boyd & Boyd PC. A lot of attorneys give their clients an estate plan called a Medicaid plan. With a Medicaid plan, you're building a plan that makes you qualified for the government to pay for your nursing home care. Essentially, you're planning to go into a nursing home. But at Boyd & Boyd PC, we know that our clients don't want to go to a nursing home. Instead, they want to stay at home. So our plans concentrate on what you need in order to be able to stay in your own home and stay out of a nursing home. If you want to be able to stay in your home, if you want to decide what level of care you receive and not let the government decide how much care they're willing to pay for, then speak with one of our attorneys. At Boyd & Boyd PC, we've been helping families plan their estates and stay at home for over 30 years. Call 508-775-7800 today to schedule your free consultation. You create the legacy, we'll create your plan.
Do you have a professional doing your payroll? If not, you should consider Capital Payroll Systems because they are the professionals. Capital Payroll Systems is the dependable service that provides accurate information and timely service. Capital Payroll is the worry-free service that provides total tax filing and new hire reporting. And Capital Payroll Systems is the personalized service that continually offers unmatched customer assistance and time-saving solutions.
Hi, this is Chris Boyd of Asset Management Resources. We're thrilled with the professionals of Capital Payroll Systems because they make my life easy. I don't have to worry about deadlines or filings and fines. I just talk to Pam or Linda and Terry, and they do all the work. Simplify your life. Talk to Capital Payroll Systems. They are the professionals.
So if you're not using the professionals, call them toll-free at 800-298-0008. That's 800-298-0008. Or visit them at capitalpayroll.com. You'll be very glad you did.
Welcome back to Something More with Chris Boyd. I'm Jeff Perry, an investment advisor representative with Asset Management Resources, sitting in for Chris this week as he's off at a conference. If you'd like to find out more about our company, Asset Management Resources, please check out our website at amrfinancial.com. You're also welcome to call the office at 866-771-8901 if you have any questions about things we're talking about on the radio, or you'd like us to take a complimentary review of your investment portfolio. In these turbulent market times, it's good to get a second pair of eyes on what you're doing and see if it's consistent with your long-term goals and your risk tolerance. So once again, Asset Management Resources at amrfinancial.com or 866-771-8901. We're on the air here with Mike Perna, a certified financial planner with Asset Management Resources. He's been in the business for 40 years, and he's comprised this list of the 10 most important things he's learned in 40 years of financial planning. We're on number 6, Mike. There's good debt, bad debt, and know the difference. So,
Jeff, yes, we are on 6, but I wanted to go back to 5 just for a second.
Sure.
Okay. One of the things I emphasize that even though your accounts may be down in periods like we're going through now, you haven't lost anything unless you sell. Now, this is also the best opportunity to buy. If the stock market, if the Dow was as high as 36,000 and today it's 31,000, well, at some point it's going to get back to 36. And if you're buying today at 31, you're buying at a discount. Okay, this is the time to load up on stocks. Okay, not to bail out of stocks. Okay, and you have to see that and understand it. And I think if you do, you'll come to the realization that the risk, okay, is only in your mind. It's only a temporary decline. Okay, see this as an opportunity, not as a period of, trauma where, you're seeing your money go down and you can't live right. Consider what the experts consider. This is buying stocks at a discount.
Well, the famous investor, Warren Buffett, who runs Berkshire Hathaway, has this quote out there, and he says he loves to buy shoes and stocks on sale. So that is a version of what we could be seeing right now in the market, Mike. So thanks for that follow-up. So number 6, good debt, bad debt, and know the difference.
Okay. We live in a society of debt. Okay. In fact, ever since the pandemic, I've hardly ever seen the green stuff floating around. Okay, that almost seems to be something of the past. And I'm not sure whether that's good or not,
right.
But we'll
it is a trend
learn.
now.
Yeah. So when we talk about good debt and bad debt, okay, it's how the debt is used that primarily distinguishes it, whether it's good or bad. Okay, I always say good debt is usually inexpensive and it buys something that appreciates in value. For example, a mortgage. You can get a mortgage, they've gone up, but still you can get a mortgage today for probably under 5%. And it's going to be backed by a house that historically has appreciated over time. So now you'd be using debt to leverage your assets. So that's what we call good debt.
Right. An appreciating asset plus the value of having a home for your family.
Yeah. Yeah. And bad debt, on the other hand, is using primarily the credit cards to buy things you don't need, okay, or to buy things you can't afford.
Right.
Okay, just because the neighbor has one doesn't mean that you need one. And if you wind up paying on a credit card, well, you're going to pay maybe 15% interest. And God forbid if you miss a payment, because you'll see that 15% quickly become 20 and then 25. And what'll happen is that you'll be making payments on your credit cards, and 90% of it will be interest and 10% of it will be principal, and you'll never get them off your back. So that's a case of bad debt.
And many times, Mike, I know you know this, but for the listeners who are thinking about what other bad debt might be, those items purchased in credit cards are usually items that have no lasting value. They might be vacations, they may be impulse purchases, lots of dining out, or toys or something that you use once or twice and put in the garage. So that's another reason to not use credit cards to buy things that are in essence depreciating or disappearing. You'll be paying for months and years for things that you don't even know what you bought.
That's true, Jeff. And if you get into credit card debt, it is going to disrupt your entire family.
Yep.
Okay. It'll lead to one fight after another, and you'll be under constant pressure. There is nothing worse than to be into debt that starts charging you 20, 25%. You have got to avoid that kind of debt.
Well, this is a great segue. I believe, I don't know if you did it intentionally, but so we talked about good debt and bad debt. And so moving on to number 7 in your list of the 10 most important things you've learned in over 40 years of financial planning, you say, don't forsake secondhand.
Yeah. We live in a society where we're constantly bombarded by advertising and marketing. You know, you turn on the TV, it's there. You turn on the computer, it's there. You open up the newspaper, it's there. You drive along the highways, it's there. Okay, and everything is pushing us to buy something new. Okay, I haven't seen many signs out there that say, "Come to Joe's secondhand shop." Okay, I don't know if Joe even shops there. Okay, but there are a lot of things, okay, that we can buy at 10% of the cost of new that work just as well. Go to a yard sale, and many times you'll see tools, garden tools. You'll find carpentry tools. You might find toys, bicycle. All of these things are being sold at 1/10 of the price of new. And in many cases, they work just as well.
Absolutely. Absolutely.
Don't worry that they're not shiny new. Don't worry about the neighbor. Think to yourself, when you see the neighbor with his shiny new, boy, that poor guy is into credit card debt. He must be in hell. Think to yourself, I want to play this smart. Okay, right. I want to put money away in savings so I don't have to put my family under the stress of being in debt, and that someday I can look forward to a comfortable retirement.
Well said. And in this day of increased use of technology, these yard sales have gone online and turned into Facebook Marketplace and Craigslist and all these other ways that you can search out these used items. So you don't even have to spend that $5 gas driving around to look for it. You can jump on your computer and search around and look for it, get a deal on something you need, as well as sell things that you don't need on those sites. So that's good advice, and I think that's something we think about. But when so many people they want something, and so they're going to drive to the store, jump online, and buy it new. So that's well said, Mike. If you do that for most things, you can't do it for all, but if you do it for most things, you can really help your budget and get some good stuff at great deals. So we're moving on here. I hope we're going to finish. We got about 6 minutes left. Number 8, you say, don't let your taxes determine your investments.
Right. I've been in the business a long time, and I've seen various investments being sold for their tax benefit. Mm-hmm. The tax benefit in many cases is a deferral of income taxes on the income of the investment or on the gain of the investment. Or, way back when I was in the limited partnership business, creating limited partnerships that had write-offs that you could use against your income. Oftentimes what happens with those kind of investments is that you pay in other places for those tax benefits. For example, in the world of variable annuities, there are many different expenses that are attached to those variable annuities. And yes, you can delay paying taxes on any gains or income from the annuity until it's taken out, but you're paying right along by paying higher expenses.
Which is oftentimes, most times in those products, hurting your potential returns.
It's not only hurting your returns, Jeff, it also is denying you. For example, if you were purchasing mutual funds in the variable annuity, you're not going to get the benefit of capital gains taxes, because everything that comes out of the annuity, other than what you initially put in, is taxed as ordinary income.
Right.
Okay. So you pay in other ways. So don't make taxation your primary objective in an investment. The investment has to stand on its own. Okay. Then consider taxation.
Good advice. Number 9, shifting the gears from investments to life insurance. You say in number 9, don't forsake life insurance. Are you saying that everyone needs life insurance, Mike? What are you saying here?
Well, here's what I am saying, okay? No, not everybody needs life insurance, but, okay, in many cases, you don't know if you will or you won't, okay? In other words, you're a 23-year-old person starting out, and you don't have any life insurance, and the only life you have to protect is your own. So you can think, well, if I died, my parents have enough money to bury me, and that's the end of it. Well, that may be true, okay? But what if in 3 or 4 years you marry and you start to have a family?
Right.
Okay. Right. In that case, suddenly your responsibility extends far beyond yourself. And if you purchase the life insurance at a young age, the cost is absolutely minimal, okay? And you'll have something. You also don't know if you're going to acquire some type of illness that will preclude you from having life insurance, or if you do have life insurance, it might be far more costly. Okay?
Those are good thoughts. And you're right. When you reach that point where you have people who are looking to you and would miss your income and your assets, should you pass away, that's that key time when you need to protect your family and make sure that you have adequate life insurance. And it's a good opportunity, when those changes happen in your life, that you get with a financial advisor and not only go over your life insurance, but go over your retirement that we've talked about and other financial matters. And, that's what we do at Asset Management Resources. And so if you don't have a financial advisor, we'd love to talk to you. And you can check us out online at amrfinancial.com or call our office at 866-771-8901. Mike, we got one more and we got a couple minutes. So I'm glad we're going to be able to finish up here. We'll go a minute long or so if we have to, Armin. So Mike, number 10, all aspects of life are psychological.
Yes, this is one of the most important things I've learned in 40 years. Okay. You can sit with clients and explain to them what they should be doing and how to do it. And you, in many cases, will get resistance. Okay. Very few people say, "You're right, I'm going to go do that." Oftentimes you'll get pushback. And the pushback is from a number of factors, okay? And most of them are what I call psychological. Mm-hmm. How people were raised, how they were taught to handle money, how they were taught to think about things. I once, proposed to a fairly well-off client, that he purchased life insurance, and his reply to me was, "Well, what good does that do me? He had 2 kids and a wife." Well, what do you mean, what good does that do you? But that was his attitude, okay? And we had to work long and hard to convince him that he wasn't the only person alive in this world.
Right.
Okay, so this is what I talk about psychological. We have to deal not only with the person's perception, okay, of financial planning, but also we have to overcome certain objections that are built into the individual due to all of his life experiences or her life experiences going back from the day that they were born.
Mike, that's critical. You really described it better than I could have. And with your 40 years of experience, I'm sure you've seen it all. Investing, personal finance, it it is at a root of how you were raised, what happened in your family, what you learned from modeling of people that raised you, and it does stay with you for the rest of your life. But that doesn't mean you're bound by that. It just means that it is your foundation, and it's an important one. And I'm glad that you had the opportunity to share your thoughts with us, Mike. This list of the 10 most important things that you've learned in 40 years of financial planning was outstanding. I hope that you do. We talked a lot last week with Chris Boyd about perhaps you turning this into an article for a financial magazine. I hope that you do that. It's very insightful. It's been great talking with you. Thanks so much for your time today, Mike.
Okay, thank you guys. And, I do hope we get a chance to publish it and send it out to our clients and our listeners, because I think, it can really help a lot of people.
Great. We got to take a commercial break right here. And when we come back, we're going to have in studio with us Brian Regan, who's our Chief Investment Officer, talking about that scary word, bear markets. We'll be right back after this break.
Families work a lifetime to develop wealth, and the quality of the estate plan that they get will really drive whether or not that wealth stays with that family or gets dispersed out. The estate plan can really help to crystallize things so that the wealth stays with the family, with the intended recipient. I think that's an important part of what we're trying to do. To me, my clients are like a part of my family. I hope they feel the same way about us, but I certainly feel that way about them. I just want to be there to help them and guide them through the difficult time that they're about to go through. And if we can take any of that burden off of them, that's important.
Call 508-775-7800 or visit boydandboydpc.com. Your family will be grateful. You create the legacy. We create the plan.
Hi, everybody. Chris Boyd here with something more for your financial well-being. Just a few years ago, a major mutual fund company completed a study which found that good financial counsel can add as much as 3% per year over time to an investor's returns, be it from behavioral coaching, appropriate allocation decisions, rebalancing activities, decisions about where to draw income, and more. Having the right help can ultimately more than cover the costs and, frankly, help investors sleep easy at night. Let Asset Management Resources be part of your team of professionals, and let us make a difference for you. For a complimentary consultation, schedule a meeting through our website, amrfinancial.com. amrfinancial.com. Asset Management Resources, for those intent on a secure retirement.
Welcome back to Something More with Chris Boyd. I'm Jeff Perry sitting in for Chris this week. I want to thank Mike Perna for joining us for the last two segments, I should say, and sharing his top 10 list of things he's learned as a financial investment advisor over the last 40 years. It was a great conversation, Mike. And if you missed it, you can go back and listen to the show on podcasts. We're on at your favorite podcast location. We also post our show clips on all the social media outlets. We're on Facebook, Twitter, Instagram, YouTube, LinkedIn. You can connect with us there. If you don't like our pages, we'd ask you to do that so you can follow us, and you can always go back to your favorite podcast location, as I said, and listen to previous shows. And Mike's list of the top 10 things that he's learned over the 40 years was very insightful. We call him our mentoring moments with Mike, where he comes on one of the classes that we present as a mentoring program, and he gives his wisdom on different subjects. So he's a great asset to Asset Management Resources, and he can be to you as well. So for this segment and the next segment, two segments, we have Brian Regan, who's our Chief Investment Officer, on the line. Welcome to the show again, Brian. Thanks for coming in.
Thanks, Jeff. How are you guys doing today?
We're doing good. Thank you. We have Armin in the studio back at headquarters in Hyannis on the board. Thanks for keeping everything sounding good, Armin. He's giving us the thumbs up. All right. So I want to start off, Brian, with something everyone knows, that the market's been a roller coaster, mostly heading downhill right here. in this kind of all year, right? Since the beginning of the year, it's been trending down. And the term bear market is certainly being discussed among investors and the talking heads on the TVs. Let's start with some of the basics. Are we in a bear market? Are we heading for a bear market? What do you think?
Well, it depends what market you look at, right? I mean, if we're talking about the S&P 500, we're not technically there yet.
We're pretty close, aren't we?
But close enough where I think,
right.
Let's just call it how it feels, I guess. In the Nasdaq and small caps are certainly in bear markets. If you want to look at discretionary stocks, for example, they're certainly in bear markets. So if it looks like a duck and quacks like a duck, it's probably a bear, right?
Right.
So I think it's fair to call it a bear market.
So a bear market, as defined, is 20% off its high, right? And so is that when they go back on the history books and they look at this, are they going to look at the S&P, or do they take the whole market composite, or do you know the technical definition?
I don't know I don't think there is a technical definition.
Right.
I just think it means 20% off the high, depending on which market you want to look at, right? I mean, some people still quote the Dow every day. I don't understand that for the life of me, because it's a really arbitrary index that I put no faith in whatsoever. It's only 30 stocks and it's price weighted, which is an arbitrary weighting. I think most people, when they talk about the market, quote unquote, they mean the S&P 500. At Asset Management Resources, I prefer to look at the All Country World Index, which is kind of closely resembles the S&P 500 for about 70% of the index, but then the additional 30% is comprised of international positions. And since we like to be fully diversified and have some international positions, I think that's a more apt comparison for the way we invest. But the performance of that one, since January 4th, has been similar as well. So, that one looks like a little bit of a bear market too. But I'm getting off a little tirade here on what benchmarks you really want to consider.
No, I think it's a very valid point, because for the investors who aren't super interested or educated, or however you want to frame it, interested on following all the indices, they see what the news reports, and the news reports that the Dow is this every day. It's across the screen. And so even though it's only 30 stocks, as you said, weighted in this arbitrary way, that's their perception of it, right? And so if they're going by how much the Dow is down and they're looking at their investment portfolio, right now, those two numbers, those two calculations really don't mesh, more than likely, depending on how they're invested, of course.
Well, lately, the Dow and the S&P 500 and the Nasdaq have been trading not really in lockstep with each other. For example, on Thursday of this week, the Dow was down significantly and the Nasdaq was up. And on Wednesday, I think everything was down on Wednesday, but
right.
The Nasdaq was down significantly more than the Dow. So, and the S&P 500 typically falls somewhere in the middle, because it's kind of weighted somewhere in the middle. So it's interesting. I sometimes, we have clients ask me what the Dow did today. I usually don't even know, because I just don't think it's a very important index. But I typically know what the S&P 500 or the Nasdaq
right.
any given day.
Right. So bear markets. So let's assume, for the sake of the discussion, that we're in a bear market. Markets are down depending on what you look at, but the S&P around 20%. A lot of stocks, individual stocks and other indices, are down a lot more than that. So we're in a bear market. How long is this going to last? And I'm not suggesting that because if you do, you'd probably be off trading somewhere and not talking to us on the radio. But typically, what's in a typical scenario?
I like you guys, and I like the vast majority of our clients, but I'd probably be hanging out with my family on a secluded island somewhere, pressing the buy on options at some point, if I knew exactly when this was all going to fall.
Just hitting the button at the right time, right? But so bear markets are scary, because we've seen, I looked at my own kind of investments portfolio, and I'm where I was, like, for my total assets, I'm like where I was 14 months ago. So bear market's a little scary. in essence, I'm still up in my investments. If you look at the last 2 years, 3 years, I'm still in the green, if you will, in the black, but they're scary. It's tough to sit through them. So historically, if you know, is this something that's going to last months, years, or decades?
It's funny. I had somebody mention to me recently, a family member. They said they sold the house in October, and they had a nice run up in their portfolio from October to January after they got invested.
Right.
And then since that was their high watermark, from in that January point, just like a lot of people, right?
Right.
And then since they've given back about the value of the house, and this person said to me, I shouldn't even sold the house. At this point, I just lost it all in the market. Well, it's not really true if you actually say the point on when they invested it in the market to the point when we had this conversation, they were down, about 1/7 of the house value. But the mental accounting that happened was at the high water mark, not at the point where he bought the house. So I think we all do that to some degree. I only point that out because you made an interesting point. Now, when does this end? Well, let's talk about the reasons why we're having a sell-off. The main reason is the good amount of inflation that we're having right now.
Right.
And I don't think that's a secret. And the Federal Reserve is working on fighting it. And at the same time, a lot of the pressures that are causing the inflation are out of the Federal Reserve's hands. And the underlying companies in these investments, if you own the S&P 500, for example, you own about 500 companies, large companies in the United States, are dealing with the pressures of inflation. So, what did we see this week, for example? We saw some big box retailers report, and we saw some people move from higher margin consumer discretionary products to lower margin consumer staples products when they bought. So this hurt the margins of these big box retailers. I'm talking about Walmart and Target.
Target, right?
Primarily.
Yep.
And I think this is kind of a natural evolution of what's going to happen as people pay more at the pump. People pay more for food. And at the same time, the cost of borrowing is also gone higher. So when we look at earnings expectations, they're still pretty optimistic. I mean, for 2023, we're looking at $250 a share. In the next 12 months, we're looking at $235 a share, which is a pretty significant growth from here, about 9-10%. But I think if you start seeing margin pressure, we've been at all-time highs around 13% on the S&P 500. If that starts to come down to 12%, I think you might need to recalibrate a little bit, and I think that's what the market's doing here. Now, the flip side of that is there's been a lot of talk of peak inflation lately, and that doesn't mean that inflation isn't high, and that doesn't mean that it's not going to continue to be high. But what people mean by peak inflation is that it'll stop increasing at a faster rate. So we saw this in the last CPI print. It was slightly lower, which was good. It wasn't as good as people were hoping, and core was even lower than that. So we're getting a little bit of a break in certain areas of inflation, I would say, particularly used car prices. So I do a lot of channel checks sometimes, for example. I went to a new car lot and I went to a used car lot. If you wanted a new car, you were really out of luck. If you wanted a used car, you had your pick of the litter. So, we've actually seen this come through in a lot of the data where the used car prices have started to dramatically correct from their seriously elevated levels.
Right.
But we're also, not necessarily seeing in the new cars yet as the, supply chain and semiconductor shortages continue. So the hope is that some of this continues to get worked out and, we start to see inflation grow at a slower pace than it's currently growing. If that happens, hopefully, you'll see longer term rates start to come down, which will give a little bit of support to the multiples on stocks. So that's the hope. When that's going to happen is anybody's guess. I think the Fed would tell you that they expect it to happen in the first quarter of this year. Didn't really happen in the first quarter of this year. So now we're kind of hoping that it happens at some point in 2022, right? And I think if it does happen, then we'll have a little bit of support. If it doesn't happen, then we will, be in for a rougher ride here. And right now, I think we're really looking for more data to have some confirmation one way or another.
How much of this do you think is just a kind of the inflation side is well said, and I agree with you. And I agree if we see some positive numbers with the inflation rate coming down, even though there's still going to be inflation, it's going to be a positive for the market, and there might be some relief there. But how much of this effect on the consumer and slowdown is not just related to pressure on with interest rates, but how much of it do you think is kind of the unwinding of the stimulus that we went through during the pandemic and all that cash, the flush of cash that the government put in the market to prop up the economy and prop up the individual consumer after COVID, and now that's gone, and it's kind of back to reality. And I'm asking you maybe a leading question, and right before the break, so I'll just frame it before the break. How much of the decline in Targets and Walmarts and other consumer type companies is just kind of this return to normal? I saw a discussion on one of the financial shows where they were kind of joking, but saying, this is the hangover after the stimulus and in other words, we had too much money in the economy artificially during COVID. COVID is passing, or that period is passing. The period of stimulus is passing. So after the break, I want to ask you if you think the lack of government spending, the decrease in government spending is a part of this as well. So we do have to take a break for the news coming up. And after that, we'll be back with Brian Regan for another segment talking about bear markets, inflation, consumer spending, all those things that are driving the stock market. We'll be right back after the news.